Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to look at the real estate cycle, get a little bit deeper into it. I was reading some comments across a bunch of different platforms, and I just think a lot of people think that we are over and done with in the, um, we'll say, real estate cycle. They think that we're going to enter some sort of 2008 type crash or whatever, and I just want to revisit it and show you guys at least the data and why I think otherwise. Does it mean that I'm 100% right? No, no one gets it 100% right. And obviously, I change my views as more data comes out and as more data is available as this market progresses. But as of right now, I'm still not convinced that that we're at some sort of 2008 type crash. I know that there's pressures out in the market where we are still short homes. The demographic still wants more homes, and the affordability, I think, is slowing things down for sure. So I'm going to just show you the cycle. Let's get into the data, and you guys can make your own decisions on it. I've made my own decision. I can tell you why I've made my decision and make my case. But obviously, just because I make a case doesn't mean I'm right or wrong. I'm not doing this and showing you the data to be right and wrong. I'm using this data to have a viewpoint of where we could be at in this commodity cycle. Looking backwards in history, these cycles, the real estate cycle in an expansionary phase, has always been a commodity boom with it. A commodity boom has not existed without this cycle. So it's important to understand where we are in this cycle, in my opinion. So let's go over it real quick. I'm going to give you a bunch of data here. So again, this is the 18-year property cycle. I think we're somewhere in this mid wiggle, and I'll show you why. Some people claim that we are going to go back through this cycle. I don't think so. I don't think we're going back through the cycle. Why? Because you spent 11 years coming in an expansion or in a recovery phase of real estate, 11 years from, we'll say 19, or let's say 2010, 2010 all the way to say about 2020, 2019, somewhere in that range, 2009 to 2019, about 10, 11 years in this cycle here. We went through a mid-cycle wobble perhaps, or maybe that's where we're at right now. And then we're going to have something after that comes in an expansionary phase of real estate. And everyone is in disbelief when I say that because they think that prices can't go higher. It doesn't mean that the prices will necessarily just jam on higher in a straight line necessarily, even though history has somewhat suggested that it does go up quite dramatically. It's the fact that we just don't have the homes in the market. That's where at least my where I get stuck in the cycle. The end of this cycle here is always ended in a hyper supply phase. I will show you what that looks like in every single cycle, and we're going to go back and forth between these. So I put this here. This is the median cost home by state. It's just a bunch of different cities all the way out. And this was the last cycle here. You can see there was some dramatic downturns in California. In Hawaii was somewhat big. This red one here, that's probably, I don't know which one, Nevada, I think is probably, Nevada's got a pretty big cycle. But this here, this pullback here was the end of that last cycle. And it ended in a hyper supply phase. It didn't end in the year 2000 because that's really where we are right now is 2000. And I'll make those cases and show you the data, and you guys can make your own opinions on why it looks like that. This could be stimulus money in the system that kind of warped our view of where we are in the cycle. But and we very well could pull back it at some point to some degree, but I don't think we're in a hyper supply phase. So understanding where we are in the market, understanding what could distort this price increase and all of that stuff matters because we could be getting false signals of where we are in this market. And maybe we do get a larger pullback in the short term, but it's going to come right back. I think it's going to come back and stabilize much more so than perhaps the 2008 crash. because we don't have the pressures in the system for foreclosures and delinquencies and all these other things. And that's why I have that viewpoint. So one of the things I wanted to touch on, let me see if I still have that article open. I might not. There's this article here. This was back in 2019 that it was written. It says new house prices drop 12% as supply surges. Wait, 2019, new house prices drop 12% as supply surges. What's going on here? We must be in a bubble. It's 2019. House prices drop 12% after supply surges. Let me zoom in on this a little bit more so you guys can see all this. So it says unwinding years of price gains as home builders try to make deals. That was in 2019. There was articles all over the place, even at this time, that people were saying we are in a bubble in 2019, 2018, and so forth. And I'll show you some of the data. So this is median price new single family houses sold, not seasonally adjusted, and we're seeing a price drop back in 2017 and 2018. And we are using here the median price of new single family houses sold. We had a pullback in 2017, 2018. And it's just like we're having today, that is very similar to in early episodes of this bull market already. And we're going to go over the last one too. So yeah, we're in a huge decline here in 2018. And things just fell apart, right? We had a gigantic 2008 crash in 2018. Well, that didn't transpire, even though prices fell during that time frame. It says the year-over-year decline of 11.9% was the third month in a row of year-over-year declines and the largest year-over-year decline since housing bust. Note the many double-digit year-over-year price increases in prior years, which attest to the boom in prices that has now outrun what the market can bear. So this person is writing that the market cannot bear it anymore. We are in a housing bubble. It is all going to crash in 2018. And that's what is this article is talking about. This is the new single family houses sold. This is a percent change from a year ago of median price. They're looking at price, not volume. So these are the price increases, and this is the decline in 2018 for the home prices. And they're saying right here, which attests to the boom in prices that has now outrun what the market can bear. And, I look at this and I look at it from a deficit surplus perspective. These guys that are price watchers don't know the value. They don't know the deficits. They don't know anything. So all they look at is price and then make their predictions based off of current price action. I don't do that. That's a difference between me and them. And I'm just giving you an example. So this is the median price new single family houses sold, the long view. So this is 2000. We had a big move higher. We had a pullback from 2007 all the way to 2010. And we went all the way up, and then we had a pullback again in 2018. Oh, this market is done with. It's completely over. And this view is a bearish view on the markets. It says, what are the dynamics of this bedraggled market? Sales of new single-family houses across the U.S. in November fell 7.7% from November 2017 to seasonally adjusted rate of 657,000 homes. So this is new single-family house sales. They're all looking at sales here, and it is falling here in 2018. It says, and if inventory of new houses for sale keeps rising in November, supply surged 14% year over year to 330,000 houses, providing 6 months of supply at the rate of November sales. So this is the supply. This is new single-family houses for sale. This is the supply of those homes, and they're going up and up and up and up and up. Right? And that's 2018 of November 2018. We are in a bubble. It's got 6 months of supply at the rate of sales in November, up from 4.9 months. So how did these guys get it wrong? What are they looking at? Now, one thing is this supply here, what they get wrong when looking at the new at the new house supply is that these homes are not all built and ready to go to that extent sometimes. Sometimes there's a lot that are in the process of being built. In manufacturing, we call that WIP. That's work in progress. So they're counting everything or work in progress. As you go into a larger and larger boom, this will naturally go up. So the fact that they can't figure that out is kind of concerning to me. Because if you're in the market, you should know that there's a market imbalance in the market and that your inventory or your work in progress of new homes is going to increase. What matters then is what is the inventory of new homes built and ready to sell, and how is that moving in terms of days on the market? This data here is basically worthless that we're looking at right here. So that's what they've got there. I'm giving you an example of a pullback, which also happened in 2017, which also happened in 2014. You get these new single-family house sales that dip sometimes throughout the markets. It's not a straight run higher. It's just like the stock market going up and down in a seasonal type fashion. You had these negatives, and some of them are larger than others, depending on the market conditions. So when I look at the data here, and this is what I've got here is the S&P 500 index. I've got housing starts in the orange line, and I've got the 10-year yield at the bottom. And what we saw here is we did see a slowdown here last market when we had an increase in interest rates from 98 to 99, 2000. You could see the housing markets kind of slow down and pull back a little bit. They went sideways for a little while. We definitely saw the S&P 500 after that pull back, and then they lowered interest rates because they saw things starting to crash or slow down in some of the markets. The decrease in the interest rate basically provided fuel for the housing starts to really take off. And if you notice, we went into a sideways period here, grinding sideways for the S&P 500. That was during an expansionary phase. The expansionary phase is above this white line. This is the expansionary phase of real estate. This is your recovery phase of real estate here. And this is your recession phase here. So this is your recession phase. This is your recovery phase. And this is your expansion phase, right? And then we went into another phase. Oops. We went into another phase, which was a recessionary phase. So this cycle repeats over and over and over and over. As you enter this phase over here, what usually happens is interest rates start to kick up. That's what the red line is as you go into an expansionary phase. The stock market does not like that and starts to roll over. That is the first kind of phase. This is the mid-cycle wobble between the two phases. That is the mid-cycle wobble. This here, if you were to look at this for your recovery phase started here in 1990, and it went all the way to about, I'd say 97, 98, in that general vicinity here as your expansionary phase starts to get kicked on. This is your mid-cycle wobble right there. Then your expansionary phase is this phase over here. So these are your phases here. This is 1, this is your 2 of your mid-cycle, and this is your expansionary phase. So if we were to look at this and kind of link this all up, this is that recovery phase, this is the mid-cycle wobble, this is your big expansionary phase of real estate. The expansionary phase of real estate, you could say, including the mid-cycle wobble, if you were to include that, was from 98 to 2008, was 10 years in duration. 10 years. If you took just the back half, you could say 2000 to 2008 was the or 2000 to 2007 was an expansion phase. So that was a 7-year cycle here to get back below average. And then this mid-cycle wobble was maybe 2 years. And then this guy was from 90 to about 97, 98. It was about 7 years here. So 7, 2, and 7, somewhere in that range. That was the cycle, 7, 2, and 7. This cycle is much larger. We are going from here, 09, all the way, and I think this is the mid-cycle wobble, just like number 2 is here. And then we're going to get a number 3 that expands higher. This here is your recovery phase because by definition, you're under the average of the white line. This is like your number 1, this is your number 2, and then number 3 is coming that we haven't gone into. Why do I think we're going to have a number 3? Because we are short homes. And I'm going to show you data to support number 3. Now, last time we got the mid-cycle wobble, which was number 2 here, we had an increasing interest rate environment where the market had to digest a little bit higher interest rates. They did turn that back and lower interest rates after. Number 2 is in a increasing interest rate environment. And I'm not sure if we're going to go lower or if they're going to try to hold rates higher. It depends on the rate of inflation. I don't think they're going to have a chance to hold rates as high as they are. I think they will fall because I do think that disinflation will come and is here, which means a lower inflation rate. And then those rates will naturally fall back down, kicking back on an expansionary phase of real estate and the inflationary pressures from that portion of the market. So this is how it lines up from last cycle to this cycle. This cycle ended with a bunch of homes being built on that cycle. We have not gone into a bunch of homes being built. So when you look at the data, and we look at the data here, these were the dates of the mid-cycle wobble and all that stuff. So when we look at this, the expansionary phases all ended in a supply bust. It was a hyper supply, too much homes came on. That happened in the mid 70s. It happened in the early 80s. It happened in the early 90s. That was the one that was the beginning of a recovery phase of real estate of the last market boom. And it also happened here in the mid to late 2000s. It ended in a hyper supply phase. The star is where we are at today. The star here is what happens is you draw down your inventories and they kind of stabilize and go higher here for a little while, depending on how much homes you have to build. And then they start to go up into a hyper supply phase. We are here. We came from like 1 month of inventory coming back up. So we could be at this mid-cycle area where inventory stays low for a little bit. And then homes have to be digested in the market at higher interest rates. I don't think that we are at a hyper supply phase because the inventory does not exist for this to be here. By definition, you cannot be here with no supply in a hyper supply phase. So I think we're in the mid-cycle wobble, and that pairs up very well with what it looked like in the mid-2000s as well. So we look at this, and this is where I'm getting my data, all right? It says, looking at the number of American households and the number of vacant housing units, Freddie Mac, the government-sponsored purchaser of mortgage-backed securities, estimates the current supply shortage of 3.8 million units, driven by a 40-year collapse in the construction of homes smaller than 1,400 square feet. Another person or group said the group of Up for Growth also arrived at an estimate of 3.8 million, using the data on the total demand for housing and the overall supply of habitable available units. That's what they used. Another person said the National Association of Realtors compared the issuance of housing permits with the number of jobs created in 174 different metro areas. It found that only 38 metro regions are permitting enough new homes to keep up with job growth in more than a dozen areas. The NAR estimates an underbuilding gap of as many as 7 million units based off of this factor. Now, who is right? I don't know who's right. All of them have massive deficits. All of them are saying that we need to build more new homes to satisfy the demand that is out there. That is what the data is showing us. We are also, when we go to look to see where perhaps forced selling pressure exists, during these timeframes, we saw a lot of forced pressure in terms of selling pressure from bad mortgages. And then they went into foreclosures. We are very low in our foreclosure starts. That pressure does not exist like previous cycles. The delinquency rate on loans for all commercial banks is at all-time lows. The pressure is not there. And then we look at checkable deposits and currency asset levels. That has gone up dramatically since 2008. And what that means is that there is a lot of money in the system where you could pay off debt and maybe prevent foreclosures from happening. Now, I don't have any facts saying what demographic or which area has that, but that is what the facts are, and I'm just presenting that for that. So when we go back here and we look at that and you think, all right, we are short a bunch of different homes and we haven't built those homes yet, what do you think the housing market is going to do? In order for this to crash like 2008, they're going to have to raise interest rates to a level that is unsustainable by the market and hold it there purposefully. And if their goal is to slow down inflation, and the inflation does not exist, but in order to kill the housing market, you're going to have to hold those interest rates higher, even though the inflation is gone. Why would they do that? What power does that give to them? And would it be allowable for that to happen by the president of America or Congress or whatever? If they knowingly are going to crash the housing market massively, would they allow that to happen? I don't know. Maybe you can disagree and you can say, yes, they're going to let it happen. Maybe that is the case. But if inflation goes down, if we have a disinflation, which we're already seeing, and that stimulus money makes its way through the system, I don't think there's any reason to keep rates as high as they are to kill a market knowingly and purposefully and go against their inflationary measures if it's moving in the right direction. And I would think unemployment would go up during that type of environment, which is against their stated objectives. But this is where I think we're at. I think we're at number 2, showing you the breakdown of basically how this looks. Now, this was a lot longer period in the recovery phase, and we became a lot more underbuilt during this cycle, which makes me think that we could go longer in the expansionary phase and maybe even mirror what this phase is here. This one mirrored it 7 years, 2 years, 7 years. This here is about 19 to 2022. This could be a 2 or 3 year phase of a mid-cycle wobble. And then this phase here, which is about 10 years, could be 10 years on the back end. Now, I don't know for sure, but that's what we're seeing. We're also seeing the same type of rollover that we had in the beginning of that market in the S&P 500. So everything kind of aligns up, and this is how I'm viewing it. This is why I think we're in the mid-cycle wobble, because this is how I'm reading the charts. This is how I'm reading by definition, that we're in number 1, a recovery phase, number 2, the mid-cycle wobble, and number 3 goes into an expansionary phase. And generally speaking, the expansionary phase of real estate is the highest returning home price appreciation stage. I know that sounds weird. I know that sounds backwards, but that's what the data suggests. You can disagree with me all you want, but this is the data, and you can make up whatever opinions you'd like. And I think what's going to happen is this is going to probably go up during a declining interest rate environment. I think interest rates may come down for a period of time. This may go higher up to a certain point, and then we're going to get another crash later on at some point. I don't know the exact time. I'm just kind of shooting from the hip here because we don't know what the data is ahead of us. We don't know what interest rates are necessarily going to do, but I think interest rates will fall down or pull back for some period of time. And we'll have to see how this is all sustainable. But I think that what we're going to see, if I were to kind of project this, and just kind of, we're gonna take this previous pattern, and what I'm going to do is I'm going to overlay it on this guy. I'm going to kind of scrunch it up. Let's shrink it down a little bit. And perhaps we get a pattern that looks something like this that ends and breaks out in 2031 for stocks, which is about a 10-year period from peak to peak. And then we get a breakout higher. But it could look something on the lines of this type of movement that is coming, and then we go into an expansionary phase. And that's what it potentially could look like. So That's my opinion around this. I just kind of wanted to share that. And maybe you guys can generate your own opinions. Let me know in the comment section what you guys think in your own opinions. Why is this important? Because a commodity boom has always happened during an expansionary phase, the mid-cycle wobble and the expansionary phase of real estate. That is where it's happened. And if someone were to state that we're at a 2008 type crash, then you don't agree with the commodity cycle, because that's generally where the money and the credit is being derived from. And that credit expansion will put pressure on commodities to go higher because you've got more money in the system chasing fewer goods. That's how I see the cycle there. That's laid out plain and simple. Let me know if you guys disagree and why you disagree. Put it in the comment section. Let me know if you agree. If you agree, yeah, that makes sense. Put it in the comment section. Let me know what you think on that. I'm interested because this is a very important thing. And if you were to look at all the other metrics in terms of where commodities are bottoming, how they're bottoming, the W bottoms and all that stuff, it's basically telling me that the bottoming process of where we're at is the mid-cycle wobble. It's 98, 99, 2000, 2001 of last bull market. And that's exactly where we are today. So that's what I've got. If you guys like the content, give me a thumbs up, subscribe to the channel, and we'll catch you later. This is Finding Value.